Thank you, Tom, and good morning to you, President Kaplan. Dallas Fed President Kaplan, one of two dissenters last week as the Fed adopted new forward guidance that incorporates average inflation targeting. You endorsed the old forward guidance and dissented on the new because, according to this statement, you prefer the committee retain greater policy flexibility beyond that point. What does that mean?
What it means is I believe strongly we should keep the current setting of the Fed funds rate, i.e. at zero to 25 basis points, until we've weathered the pandemic and we're well on track to achieve full employment and price stability. That, by the way, is probably going to take at least 2.5, 3 years. The issue is, beyond that point, once we've weathered the pandemic and we're on track to reach our goals, I probably think it's appropriate to remain accommodative, or maybe even highly accommodative. I'm not sure it's appropriate to decide right now that at that point we should leave rates at zero. I would rather leave those judgments to future committees because I think the world is going to look very different post-pandemic than it does now, and I'd rather leave the judgment to future committees who can assess all the factors that are relevant in order to make that decision.
Well, does that suggest you think that we could come out of this with faster growth than most people are anticipating?
Or I'll put it a different way. In my own forecast, I think we're going to have solid growth in the third quarter, 30% annualized, a strong fourth quarter, above trend growth in 2021. And in my own forecast by the year 2023, and I know that's going out a long ways, we could start to approach an unemployment rate certainly below 4%, say 3.5 to 4%. And so I believe that is possible. Obviously, we'll have to see, and a lot of that is going to depend on how well we manage this virus, fiscal policy, and a whole range of other decisions. But when we get to that point, the question before the House is, do you want to still be accommodative in light of our new framework in order to meet our inflation goal? In order to remain accommodative, does that mean we need to leave rates at zero? And I'm not sure, but that's the point. I think it's hard to know right now that far in advance, and I want to make those judgments at the time.
Is that enough to dissent on? Important enough?
For me, it was, and the reason it is by making this commitment now. First of all, there are a few reasons why I dissented, what I just went through. And then my own view is I'd rather use forward guidance where we got more positive benefit. Going into the meeting, the world already thought that rates were going to stay extremely low for the next 2 or 3 years. And so my concern was by making this commitment now, I wasn't sure how much additional benefit we're going to be. But on the negative side, it means if you're in the asset markets, if you're a saver, if you're a pension fund, if you're an insurance company, if you're a market participant, it basically gives you a signal that you're going to need to take more risk. And my concern is about building up excess risk-taking, which can create fragilities and other excesses in the system, which are hard to see in real time and easier to see in hindsight, but could create issues for us to meet our goals. And so that was the reason I felt that the costs were not worth the benefits.
Well, in his news conference, Chairman Powell was at pains to say over and over again the new guidance is strong and powerful, but there seems to be a lot of skepticism on Wall Street about that. Well,
and I wouldn't overread the market reaction. It's been a few days, and I think these decisions usually are not, the reaction is not measured in 3 or 4 trading days. It's measured in the fullness of time. I think making a statement that people should expect even beyond the pandemic, that rates are going to stay at zero until we reach 2% and are on track to moderately exceed 2% for some time. I think as the months and the years go by, I think people will increasingly realize the power of that commitment. And so I think it's more significant than the markets may be initially realizing.
Well, Washington is consumed now by a fight over the Supreme Court, which many analysts say pretty much ends chances of getting any kind of additional stimulus, at least before the election and possibly afterwards. What does that mean for the economy?
Well, I think in my forecast for this year, I think some additional fiscal stimulus is part of that. And one of the unusual features of this downturn has been consumer spending has been very strong despite the elevated unemployment rate. That usually doesn't happen in a downturn, and it's happening because of strong fiscal support. And so I think some extension of unemployment benefits is critical. And I also, second thing I'd mention is aid to state and local governments, I think, is also important. They have big fiscal holes. They are needing to cut back because of that right now at a time where we're asking them to shoulder more responsibilities in fighting the pandemic and getting kids back to school and a number of other responsibilities. And so I think some fiscal support, I'm still hopeful for it, and I think it's important to this recovery.
The markets are, at this point, not just discounting what you did last week, but concerns over the Supreme Court and a round of pandemics. We've been asking for months about whether markets were too high and might fall, dragging down the economy. What's your read on what's going now?
Well, I won't go too far in this job commenting on the markets other than to say market cap to GDP is currently at a historic high. And at historic highs. There's some understandable reasons for that, but normally when you've had this kind of run, some kind of correction could actually be healthy. And so the thing I watch when I see a market sell-off is our credit spreads widening, and I don't see them widening, which tells me right now this is more of a correction, maybe not a fundamental change. If I saw credit spreads widening along with the sell-off, that would tell me something different, but I'm not seeing that.
Well, tight credit spreads and low interest rates suggest the Fed policy is working at the moment. But if we do have a need for additional stimulus and we don't get it, is there anything the Fed can do, or are you sort of out of the game, done what you can do?
I think monetary policy has done a lot. We still have more things we could do. And certainly with either asset purchases, I think we could do more to help small, mid-sized businesses. But I think the path of the pandemic, the incidence of the virus is still going to be the #1 determinant of how fast we recover. And I think some amount of fiscal policy secondarily is important. But I think monetary policy will do its part. It's not, though, the primary driver of this recovery right now. I think it's still how well we manage the virus.
The other issue you just mentioned, the Main Street lending program, and you also talked about the municipal lending facility. Chairman Powell goes up to Capitol Hill, and they're going to be asking him the question, why aren't those working? There's been almost no take-up. One loan for the municipal facility, and only 0.2% of the money for Main Street has been lent. What's wrong with the Fed programs?
Well, so let me just segment these. I think it's a mistake to judge the effectiveness of most of these programs by the take-up. The Main Street program, let me put off to the side. That's a little bit different. But on a municipal finance program is a good example. We have backstopped issuance in the municipal finance market with a capacity of $600 billion. As soon as we announced that program, the municipal finance market rallied. Money flowed into that market. That's true with the corporate bond market. It's true with other markets that we've done this for. So I actually think the measure of how effective those programs are people able to issue in the private market? The fact there hasn't been much take-up, we're intended to be backstop pricing. So I think those programs have actually been very, very successful. The one program we've scrutinized more, though, is the Main Street program. On that program, take-up is a good measure of how effective it's been, and has been a lot of discussion. There's still stringent credit requirements for that program. The banks have to agree to lend as part of that program. And so we are looking at ways, and there's been discussion, can more be done to make that program more attractive? But again, the Fed is a lender, not a spender. And in order to ease the requirements of Main Street, you'd have to be willing to tolerate more credit losses. And that's not a Fed decision. That's a decision for Congress and the Treasury.